Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, February 10th, 2016. Investors took about $4.3 billion out of the conventional fund business, and I don't think anybody would be surprised by that under the idea that we had actually okay earnings news, but really I think what shocked a lot of people was the continuing decline of oil. Dipped below 30 once again. And also we had Janet Yellen testify before the House in the Senate. It's her semi-annual meeting with them, and basically left the future interest rates increases on the table, and I think that spooked a lot of people. They were a little bit concerned, and we had this idea that we've had some major league global growth issues going on, and the market has just gotten tanked in the last several weeks, and I think that really freaked out investors quite a bit, and it caused them to pull money out, and certainly I think the oil was kind of the biggest thing. Again, it closed at $27.45 a barrel for the weekend on Wednesday, so that's certainly an issue, and it caused a lot of people to duck for cover and dive for safety. Let's take a look at our macro groups to see how the flows actually panned out and what groups actually got money and what actually lost money. Equity funds lost some money, about $1.4 billion left their coffers. Taxable bond funds, though, took in about $400 million. We'll get into detail on that. Muni bond funds actually was the bright, shining star that we saw during and we've seen for the last several weeks. About $800 million took in the largest amount of money. And money market funds, kind of ironically, lost about $4.1 billion, and we have some hypothesis on that as well. We'll just talk about that later on. Let's take a deeper dive into equity funds and see how that actually panned out. We had about a 3.61% decline in the market overall for equity funds, so it really was a bad week. It's the first week in three, though, that we've seen negative returns, and to that magnitude, certainly. We had about $1.4 billion in outflows. It's the fifth week in six that we've seen outflows out of this group, and ironically, domestic equity funds saw about $3.1 billion in outflows, but non-domestic equity funds, and by the way, this is the 13th week in 14 that we've seen outflows out of that group. Non-domestic equity funds for the second consecutive week saw inflows about $1.7 billion, and you know how that panned out is as we take a deeper dive into that is large cap and mid cap funds actually saw money leave their coffers. Large cap funds saw the largest amount, about $2.4 billion, leave that group, and mid cap funds saw about $700 million out. Now when we take a look at the international side, and this is where the head scratcher is, we saw that international equity funds actually took in $1.7 billion, and we took a look at global equity funds, and they saw just about $53 million in inflows, but inflows nonetheless. And the reason this is a head scratcher is if we take a look at ETFs now, we can see a little bit of a dichotomy. For the second consecutive week, we've actually seen outflows, but this time only to the tune of $100 million. And the big recipients of money were SPY, so we saw the Spider S&P 500 taking about 3.1, and we saw the Spider Dow Jones Industrial Average take in about $0.9 billion. So really the big players, the big known names actually attracted money, where on the open-end side that was not necessarily the case. If we take a look at the bottom of the barrel, though, we saw the First Trust, New York Stock Exchange, ARCA, Biotech actually got a big black eye, $833 million, the largest outflow we saw out of that group. And then we saw the Spider Financial Select Sector ETF down about 826. And a lot of people with the Fed, a lot of people are betting that the Fed won't raise interest rates immediately. And if that's true, that was a real drag on the financial community. And so banks in particular over the last week and a half have really taken a bath, and under the idea that the economy is not strong enough for the Fed to continue on with its rate hikes. And I think in recent days we've actually seen maybe some support for the idea the Fed may still increase rates, but that's certainly been the story. Let's take a look now at what happened on the fixed income side. Fixed income investors basically put about $360 million to work in this group. It's the first week in 14 that they've actually put inflows into the fixed income side of the open-end business. It's the first week in three, though, that we saw negative returns, 0.67% return as a decline. But where we actually saw the money go in, it totally makes sense, is government mortgage funds saw about $600 million of money come into their coffers, and it's the 26th and 27th week that we've actually seen those inflows. So it really has been quite a story that people have been following as well. On the bottom side, this is that risk avoidance that we talked about in the beginning of the show. High yield funds actually saw the biggest outflows, $322 million, and it's the 15th consecutive week that we've seen outflows out of this group. Now, if we take a quick look at our ETF universe, we kind of see some similarities there, but we are seeing a $1.2 billion inflow. So a tale of two cities in this case. Fifth consecutive week that we've seen inflows into the ETF, fixed income ETFs. And at the top of the group is iShares 20-plus Treasury bond. Well, we all know that the yield on the 10-year Treasury actually did decline, so it was a real boon for Treasury investors. And also we saw about $582 million going to the iShares 3 to 7 Treasury bond as well. So these two groups actually took in money, and I apologize, the 20-year Treasury plus actually took in the bigger amount of money, but the iShares 3 to 7 actually took in $568 million. And at the bottom of the barrel, we see that the iShares iBoxx High Yield Bond Fund ETF basically was the big loser. Only about $541 million left that group. So again, treasuries were the name of the game. People did a little bit of corporate investment grade as well at the top, but at the bottom, we really see the high-risk assets actually suffering the biggest outflows. Let's take a look at the Muni Bond Fund universe. This has actually been a shining star for quite some while. $816 million in inflows, one of the bigger ones. We've been seeing 6 and 7. This is 800. 19th consecutive week that we've actually seen inflows, and it's the second consecutive week that we've seen plus-side returns, this time only to the tune of 0.14%. But hey, what do you expect for a Muni Bond Fund? Right, on a weekly basis, so really not all that bad. National munis actually took in the biggest chunk, $655 million, and the rest would obviously have gone to single state munis. Obviously, for the national munis, this is the 19th consecutive week they have seen inflows as well. It's been off and on inflows and outflows for single state munis as well. Let's go ahead and take a look at money market funds, our last category. For the second week in a row, we've seen outflows, this time to the tune of $4.1 billion. Taxable money market funds, though, only saw about 25 million, not billion, only about 25 million in outflows. And how it stacked up is we saw institutional investors have about 1.62 billion in net redemptions, while we saw the retail investor, again, die for safety, inject about 160, so we had a net of about $25 million in outflows. Not a big deal. But tax-exempt money market funds saw the biggest outflows, about $4 billion. I told you a little bit of hypothesis here, is that we are assuming that it's a year-end function. People were kind of putting money into kind of safe haven areas where they could get a little bit of a return, and tax-exempt money market funds were kind of a popular area to go into. So at the year-end, when we have all these year-end things going on, whether it be funding 401ks or paying other type of distributions like bonuses and the like, that is what we think this was being used for. For the last 2 weeks, we've seen some pretty big outflows, and that's what we can kind of put it to, considering there's been kind of this risk-off, risk aversion approach to investing. Well, actually, we saw some good news today, and I remember I was telling you about that. Some of the news coming out may be contradictory to the Fed stopping or putting the brakes on those interest rate increases. One of the things that we saw today was better than expected retail sales, and it came in about 0.2. Most analysts thought it was going to be about 0.1, so not a big difference, but certainly a plus for investors to take a look at and say, hey, retail investors, retail sales are still pretty strong. Well, if you want to do a deeper dive, you can certainly go to our website at www.lipperusfundflows.com and pick an area that you want to take a deeper dive in. If not, you can meet us next week where one of our analysts will talk about the flows for that period. Well, until that time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.